So good morning, everyone, and thanks for joining us for the quarterly Tecnoglass results. We couldn't be more excited to report Q1 results this year. As you can tell, we were able to report record levels of pretty much every financial metric across the board: revenues, operating profit, gross margins, EBITDA margin, cash flow, backlog. So all in all, it was a great quarter for us. Let's kick it off with giving you a summary on a revenue side, which we were able to grow 27% year over year, mainly driven by US based revenues. And within US based revenues, residential continues to grow extremely well, growing 71% year over year, and then commercial growing 18% year over year. The main drivers of this growth continue to be our successful push into the single family residential market, which is doing extremely well. And within residential market is a combination of expanding geographically, expanding our dealer network, and broadening our product base. We'll go into more detail as to why we are gaining market share, what the drivers have become, and why are we in a position to continue taking market share away from our peers. From an EBITDA perspective, moving on, we were able to drive EBITDA margins that we had not seen historically. Our gross margins were up 590 basis points, driven by the results of automation, headcount reduction, efficiency from a raw material perspective. And all in all, we were able to also get a significant amount of operating leverage on SG&A. As a result of that, our operating margins drove to a record of 23%, which again, we had never seen before. So this is, in our mind, very sustainable. We are looking to obviously continue growing revenues to drive incremental operating leverage. So we are definitely bullish and rising our guidance for the year to come, as we will discuss further. Moving to backlog, this is very encouraging, obviously, especially after last year, seeing how backlog is rebounding as a result of many commercial projects resuming activity, and many new ones, to be honest. In the Southeast, especially where we have our strongest presence, we're seeing a lot of activity, a lot of pipeline. It's a shift that we had not seen before from a demographic perspective of a lot of people moving down to the Southeast as a result of everything, the pandemic, and obviously coupled with low interest rates and low taxes in the South. So we feel that we are well positioned to address that upcoming growth and the demographic shift that we're currently seeing in the US. Single family residential, just to touch a little bit farther into that, we're seeing a nice mix because we are now starting to enter into conversations with home builders through our multi-max product, which was very new up until last year. So we're seeing that there's a lot of upside potential coming from multi-max, not only from our legacy products, Elite and Prestige, but also with a lot of conversations taking place with home builders. There's a whole lot of potential on this new space that is opening up for us. So we're also very excited about that. There's a few things that we wanted to highlight as far as competitive advantages from everything that is taking place right now. A lot of companies in the US are seeing significant inflation, commodities, wages, energy, transportation. And because we are fully vertically integrated, we control a lot of our supply chain through our venture with Saint-Gobain. Being able to have a full vertical integrated process within the same factory allows us to basically not depend on any long supply chains. And that's playing a huge role in what's happening, because as a lot of our competitors are raising prices, we're not encountering these same pressures. And as a result of that, not only are we not getting more expensive, but our lead times are significantly lower than the competitors. We're talking about some other peers running into 15, 20 weeks. We're running into 5 to 6 weeks. So for us, we're in the right place with having a stronghold in the Southeast at the right time, at a time where a lot of people are moving down to this region, and at a time where, because of our strategy and being fully vertically integrated, we are not encountering the same inflationary pressures as our peers, and as a result, we're able to maintain prices or raise them lower than the competitors. So we feel very excited about the opportunities to come. From a leverage perspective, we continue to delever. Now we are close to 1.3 times adjusted debt to EBITDA. So we're in a great position from a balance sheet perspective. We completed the recap of taking out the bond and putting in place this new bank facility. So we're expecting $11 million in savings from this refinancing this year, which is helping cash flow, which for the first quarter alone drove $29 million in operating cash flow and over $22 million of free cash flow. So we're building a nice cash balance that we are looking to put to use over the near future to enhance shareholder value. As a result of all of this, we're increasing our outlook. We are now expecting revenues to be between 420 and 435, and that is up from 400 to 415. And we are expecting adjusted EBITDA to be in the range of 115 to 125 million, and that is up from 100 to 110 million. So nice expected growth at the midpoint of about 23%, and that is driven by all of the factors that we just mentioned. So we're already seeing nice progress in April and May, so the activity continues, and we're very optimistic about the rest of the year. With that, we thank you again for joining us and hope to see you in the next call. Goodbye.